how the fixed income markets and the currency markets are faring, what the outlook over there is. We've got Jayesh Mehta, who's country treasurer at Bank of America Merrill Lynch, joining us on the show right here from Mumbai. Now, Jayesh, to begin with, there was a lot of speculation up until last week about what the government's additional borrowing would be. We did have an official from the Finance Ministry state off the record that it would be 40,000 crores, but on Friday we had the RBI officially issue a statement saying that it will be 40,000 crores. Ideally, should we expect to see bond yields cool, because some amount of that, the nervousness has gone away? You'd know for certain that the government's going to borrow an additional 40,000.
Yeah, I think though market did react by 10 basis points in the morning, but it really came off because this was the time after the RBI's announcement. The first working day was today morning, and market came off by 10 basis points, went up to 857. But I think there is a strong, on the other side, we have a strong belief of OMO to be continued, and that is supporting the market, and it's back to Friday's closing level. So that's really not changed the yield as of right now. And along with that, there is an expectation built in of some CRR cuts somewhere in January, and also maybe a rate cut maybe in March, April. Maybe April would be the right situation. So I think with that, it's really holding up at 847, but we still, it's a very, very difficult market to gauge either way. As of right now, we see yields in the range of maybe 10-20 basis points either side, but nothing really dramatic till we see some action.
Sure, right. Now, Jayesh, the liquidity deficit really in the banking system is running at about 1,15,000 crores. About 10 days back, we saw some banks actually approach the marginal standing facility window and borrow money at that window. Do you see that likely happening again? Do you believe that could maybe force the Reserve Bank of India to initiate a CRR cut much sooner than the 24th of January?
Yes, that is what people are expecting, but I don't personally think till 24th January they would do anything really dramatic because there is an expectation that the advanced tax money will flow back and there will be some respite there. But yeah, technically it should happen before 24th of January, but the way Reserve Bank has been reacting, I think they would wait for the policy day to announce that.
Okay, what is the expectation then going forward in terms of the overall trend on the yields from here? I mean, what is the kind of range that you're looking at?
I think there are two parts to it. One is expectation and one is what actually falls out, right? If you look at the fundamentals and all that is really, really bad for the yield scenario, except bearing OMO, which is the reality which is there, which is kind of holding the yields going up. But more importantly, I think the expectation is very, very high that there would be a CRR cut maybe on the policy day or before the policy, and also a rate cut maybe at the end of this quarter. So maybe early April or something we see a rate cut. I think we are the only country in the world who is still the lending rates are higher than 2008. So I think that really, and the growth has really suffered, right? So there is a huge expectation which is not really letting the yields go up. If you really look at overnight at 8.5%, 10 years trading at below overnight and maybe going down to 837 could be very much possible. But that's all purely on expectation. If we don't see any action in January, it can really, really shoot up. So it's a very, very difficult market. One has to be very nimble. That's what one would say.
Right. Now, Jayesh, everyone's working on the assumption that the fiscal deficit will come in somewhere in the 5.3 to 5.5% range. But do you believe the bigger concern is really not this financial year, but the next one when we see elements like the food security bill kick in? There's also already talk about, a likely loan waiver of certain rural sector lending by public sector banks. So all of that together, do you believe next year is going to be the bigger concern for the fixed income market?
No, that's exactly is holding up the yield. Apart from having a strong expectation of rate cut, we won't be surprised if the yield goes down, but it's the next year's concern which is really holding up the yield. And as I said, we need to really see some action. So maybe if we see some one rate cut coming even in April, and then the expectation for future rate cuts would be built in, that can a little bit ease up. Of course, there is a draft on Basel III. We need to see how it pans out. But yes, next year is a concern. So it's slippages on the fiscal, which is what is the concern this year. It's kind of managed because of expectation plus actual action of OMO. But next year is going to be a different thing. But we need to see, that's why we need to see a rate cut in the beginning so that expectation and momentum is built up.